Have you ever really thought about what a bank's financial safety net is? Well, today we're going to unpack Tier 1 and Tier 2 capital. Now, it might sound a little technical, but trust me, it's the absolutely crucial system that's designed to keep our entire economy on its feet. Let's get right into it.
I mean, think about it. We all put our trust and our money into banks. But what's really stopping them from just going under when the economy gets rocky? The answer is this mandatory financial cushion. And today, we're going to see exactly how that works.
So, why do they even need this cushion in the first place? Well, the thing about banking is that it's a risky business by its very nature. Banks take our deposits, right? And then they turn around and lend or invest that money all in the hope of making a return. But when those investments go south, that cushion is the only thing standing between a stable bank and, well, a total collapse. It's what protects us, the depositors, and the whole economy.
Okay, but here's a key detail. Not all of a bank's assets carry the same amount of risk. A super safe government bond is worlds away from, say, a high-risk startup loan. The system has a smart way of dealing with this, called risk-weighted assets. It's basically a method for scoring everything in a bank's portfolio to figure out exactly how big its safety cushion needs to be. The simple rule is, the riskier your investments, the bigger the cushion you need.
And this isn't just about keeping one single bank safe. If the 2008 financial crisis taught us anything, it's that the whole global financial system is deeply tangled together. A bank failure in one country can set off a chain reaction across the entire world. That's exactly why international regulators got together to create one common set of rules for this safety cushion.
And that's where the Basel Accords come in. This is the official rulebook. You can think of it as the international standard that makes sure banks everywhere are playing by the same safety rules, holding enough capital to handle their business and absorb unexpected losses without causing a global meltdown. All right, so how is this whole safety net actually put together? Well, it all starts with the most important layer, Tier 1 capital. This is the bank's absolute core, its first and strongest line of defense. So, Tier 1 is the highest quality capital a bank has. It's made up of the really solid stuff, like shareholders' equity, that's the money invested by its owners, and retained earnings, which are just the profits the bank has saved up over the years. To make it relatable, think of your own finances. Tier 1 is like your most accessible cash. It's the money in your checking and savings accounts that you can use right away to cover an emergency. For a bank, it's the absolute best indicator of its financial strength.
Okay, but what happens if a bank takes a really big hit? A loss that's even bigger than its core capital can handle? That's when you need a backup plan. And that brings us to the second layer of defense, Tier 2 capital. Tier 2 is what we call supplementary capital. So, sticking with our personal finance analogy, if Tier 1 is your ready cash, Tier 2 is kind of like having to sell your second car in an emergency. It definitely has value, but it's much harder to turn into cash quickly. For banks, this includes things like subordinated debt, which are loans that get paid back dead last if a bank fails, and general reserves that are set aside for potential loan losses. And this table here really just lays it all out, side by side. You can see the key differences so clearly. Tier 1 is for absorbing losses while the bank is still up and running, a going concern. It's high quality, it's liquid, it's reliable. Tier 2, on the other hand, is designed to absorb losses if the bank is actually failing, acting as that final shield for everyone's deposits.
Okay, so we've got these two tiers of capital, the core defense and the backup plan. But how do regulators actually use them to see if a bank is safe? Well, it all boils down to calculating one single crucial number. And that number is called the Capital Adequacy Ratio, or CAR for short. It's a surprisingly straightforward formula that gives regulators a quick snapshot of a bank's health. They just take the bank's capital and divide it by its risk-weighted assets. Let's see how that plays out.
Let's put some real numbers to this to make it concrete. Imagine we have a large bank, and it's sitting on $200 billion in that core, high-quality Tier 1 capital. And now, let's say after you go through and weigh all of its loans and investments for how risky they are, you find out its total risk-weighted assets come out to $1.2 trillion. So you do the simple math, that $200 billion divided by the $1.2 trillion, and bam, you get a Tier 1 capital ratio of 16.66%. So the big question is that any good? And according to the official rulebook, Basel III, that is very good. You see, the rules say banks have to maintain a minimum Tier 1 ratio of 6% and a total capital ratio, that's Tier 1 and Tier 2 combined, of at least 10.5%.
So our example bank, sitting pretty at 16.66%, is well above the minimum and would be considered very safe.
Now, some of you might be thinking, hang on, I'm sure I've heard of a Tier 3 capital before. And you know what? You'd be right. It did used to be part of the system. So, whatever happened to it?
Yeah, Tier 3 used to be this extra third layer of capital that some banks held specifically to cover risks from their market trading activities. But ultimately, regulators looked at it and decided it was just making the whole system too complex and maybe even a little less safe. So under the newer, stronger Basel III rules, Tier 3 was completely removed to make the framework clearer and more resilient.
Okay, here's a bit of financial jargon that sounds, well, a little grim, but it's actually a super important concept for protecting your money. It's called gone concern capital.
Remember how we said Tier 2 capital is for when a bank is already failing? Well, that's exactly what gone concern means. The bank is gone. Its whole purpose is to act as a kind of sacrificial layer. It's designed to absorb all the losses first, making sure that depositors and other major creditors are protected and get their money back before anyone else. It's a critical backstop for customer funds.
All right, we have covered a ton of ground, so let's boil it all down. Why should you or any of us actually care about a bank's Tier 1 and Tier 2 capital ratios?
Because at the end of the day, it's all about safety and stability. Plain and simple. A bank with a high capital ratio, especially a high Tier 1 ratio, is just a healthier, more resilient bank. It means it has a strong enough buffer to handle major financial shocks, which means it's far less likely to fail and threaten customer deposits or the economy as a whole.
So there's no doubt that this whole Basel framework has made the global banking system a lot stronger. But let's be real, the financial world never stands still. New risks, new technologies, new challenges are emerging all the time. And that kind of leaves us with a final thought to ponder. We've built a pretty robust safety net, but will it be strong enough for whatever the next crisis decides to throw at us?